Hi everyone, welcome to the online class Kilora. I'm Lavanya. So today we are going to learn one of the important topic that is accounting cycle. So let's start with the meaning. Accounting cycle is a systematic process that business follows to record, analyze and report financial transaction. It includes steps like identifying the transaction, recording entries, posting to the ledger, adjusting the entries, preparing financial statement, closing the books and verifying the post closing trial balance. So these are the steps it includes. Here, the main purpose of this accounting cycle is to ensure the accurate and complete financial record for effective decision making and reporting. It keeps tracking the financial informations, and also it is like a step by step process for recording, analyzing and summarizing the financial transaction. As you know, it includes activities like journalizing, posting, ledger, preparing financial statement, closing the book, and verifying the post accounting trial balance, etc. Let's go with the definition. The accounting cycle is a structured sequence of steps that follows to systematically record, process, and report financial transactions within a specific accounting period. It encompasses tasks such as identifying, recording, adjusting, and summarizing the financial data to produce accurate and reliable financial statement. This cycle is typically repeated for each reporting period to maintain organized and transparent financial records. Let's know the steps in accounting cycle, and also let's know what are the topics will be covered in this accounting cycle. We'll know the introduction of accounting cycle, that will go overview in the accounting cycle briefly, and next we'll understand the importance of accurate financial reporting for business. And these are the steps in accounting cycle, that is, first we'll identify and analyze the transaction, then we'll prepare a journal, then we will post that entries into a ledger and prepare an unadjusted trial balance. These are the four important steps which comes under accounting cycle. Next, we'll understand the adjusting entries. I will explain all the adjusting entries and then necessities, and also we'll understand the types of adjusting entries also. The next one is adjusting trial balance. We'll understand how to prepare this adjusting trial balance, and also will ensure that debit and credit still balanced. And next, financial statement, and that is income statement, balance sheet, and the statement of cash flow. We'll understand how to prepare this and what are the purpose of this. We'll go overview through this. And next, closing entry. After posting into journal, ledger, will trial balance, then we'll close the entries. We'll understand this and we'll understand what are the revenue accounts and what are the expenses accounts. Next, we'll do post closing trial balance. Then we'll ensure all the temporary accounts are closed. And next is reversing entry. It is optional. It is just to verify whether the assets, liabilities, and liability and credits are balancing or what. We'll understand its purpose and benefits also. Next, we'll understand what are the importance of accounting cycle. These are the three important things that we have to keep in the mind. That the first one is ensuring accurate financial reporting, compiling with regulatory requirements, and providing information for decision making. And finally, we'll conclude with these all key points and prepare implementation of accounting cycle. Let's understand one by one. We'll go through recording transaction. Here it is the second step in accounting cycle. The first one is identifying the transaction and analyzing the transaction. As you know, nothing but we have to identify, for example, what kind of financial activity or an event that affects the company account, like sales, or it might be purchase, or it might be expenses or payment, like that. We have to identify the transaction. Then we have to analyze it or classify it, like by determining the type of transaction such as revenue, expenses, asset liability, or equity, whatever it might be. It helps to understand how it impacts the financial statement. This is the two things we are going to do in the first step. Then we record the transaction. Here we'll go through recording the transaction. A recording transaction in accounting involves capturing the financial impact of business event in company accounting system. Here, this process is crucial for maintaining the accurate and organized financial recording. So, this is the basic step we have to learn. If we do any mistake, if any transaction goes wrong, then the whole accounting record, financial record will go wrong. So we have to maintain and understand this carefully. So these are the steps which involves in recording the transaction. The first one is, as I told, it is identifying the transactions, recognizing the occurrence of a business event or a transaction that has financial implication. This can include sales, purchase, expenses, investment, or any other financial activity. The next thing step is analyzing the transaction. So you have to classify uh, what type of transaction it is, like revenue, expenses, asset, liability, whatever it is. We have to identify whether the transaction is going to increase or decrease the account involved. The next one is make journal entries. Here you have to record the transaction by making journal entries. Journal entries which includes date, accounts affected, and the corresponding amounts, that is debit amount and credit amount. Each entry should have debit side and credit side. Debit side should be always at the left side and the credit side should always be at the right side. So we have to follow the accounting equation. Asset is equals to liability plus equity, which remains always balanced, should be balanced. The next step is post to the journal entry, journal ledger. Transfer the information from the journal entries to the journal ledgers. So, the journal ledger is a comprehensive record of all the accounts used by the company, organized by the accounting type. Here we have to record all the journal entries into a ledger entry. Then we have to record all type of accounts used by the company and organize the types of account. And next step is maintain the debit and credit. Here, if the debit amount is 1,000, the credit amount also should be 1,000. Then only it will be balanced. This is very important to be a balanced. This adherence, we follow the double entry accounting principles to balance the total debit is equal to the total credit. So it helps in maintaining the integrity of the financial records. For example, let's have, if a company sells goods for cash, this journal entry looks like this. Like we'll have four columns, that is date, account, and debit amount and credit amount. We'll understand this statement carefully. The question is, if the company sells goods for cash, here you would debit the cash amount to record the increase in revenue. So, and the credit the sale account to show the increase in income. Here in this transaction will be revenue transaction or a sale transaction. So it represents the income earned in the company. So what we'll do in debit amount, will add a amount which is given in the transaction by filling entering cash account in the cash column, and debit amount will be credited in the debit amount, and in the sales account will enter the amount in the credit. So it should be balanced by using this accounting equation, like here the asset is the cash and the liability and equity. Here the liability will be sales. So we have to balance this both. So debit amount will have 1,000 rupees and credit amount will have 1,000 rupees. So it will be equally balanced. So the recording transaction accurate is fundamental to produce reliable financial statement and ensure the financial health and compliance of a business. This is uh, how we analyze the journal entry. Shall I give one more example? Like, let's say you made a sale for a product worth 500 rupees. So here the transaction will be revenue transaction, as I given this example. Same, the sale of a product worth is 500, so the sale is related to the revenue transaction since it represents the income earned by the company. So here the debit call in the debit column you'll had cash account to record the increase in revenue and credit the sale account to show the increase in income. So here, the transaction increase in the both cash and sales. So it shows the company has earned 1,000 rupees, 500 rupees in revenue for the sale. This is how the journal entries are posted. Let's understand deep into it. Here, let's understand the meaning of it. Journal entries are a systematic record of financial transaction in a chronological order in the accounting records of the business. These entries serves as a initial step in accounting process and it is very important for maintaining the detailed and accurate account of company financial activity. So we have to have we have to understand the systematic record of financial transaction will be in a chronological order to maintain the accounting record of the business. Here we'll have three columns, that is date, accounting debit, accounting credit, and amount. So in accounting date, in the date column, we'll post the date which is related to the financial transaction occurred on that date. We'll analyze the date which is given in the transaction and we'll fill it. Next is accounting debited. In the debited column, the account that is being increased in value will be added here. It will be always in the debit side. Accounting credited, the account that is being decreased in the value will be always credited in this account. And this column will be in the credit side. And finally, the amount column. Here, the specific amount is associated with each account, which indicates the monetary value of the transaction. Here, in the transaction, the amount will be given. We have to post it in this amount column. There will be two amounts, that is debit and credit. When if it is increased in the value, it will be credited debited amount will be debited in the debit column. If it is credited decreased in the value, it will be credited in the credit column. Here we'll know the advantages of journal entry. The first one is it provides date wise records of all the transaction, so for the reference of the transaction will be quick and easy. When the date is given, it will be easy for us to refer the transaction very easily by analyzing the date. By entering the journal narration, it helps to understand the purpose and the nature of entry. In the journal entry, it is very important as to analyze the or write the journal narration. So it helps us to understand the purpose of this entry and the nature of entry. The next one is it gives overall record of all the transaction at one place. It helps us to keep all the records of the transaction at one place, so it will be helps us to understand the types of entries, purpose, and also we can refer it easily. It helps to identify the errors which were in the books of accounts. It helps us in identifying the errors in the books of account. Next one is it is a book of prime entry or original entry. It is also called as a book of original entry. and it helps to avoid the mistakes or errors in the books of account. So let's prepare a journal for the transaction given below. The first one is we have to understand the all the transaction given in the journal, so it will be easily identifiable what type of transaction and what type of entry it is. Let's go one by one. Here, the first entry is cash paid for installation of machinery, that is 500. So, here it is related to the expenses transaction. So, we debit the installation expenses account to record the increase in the revenue. So, to installation to the machinery, we credit the cash account to show the decrease in cash as it was paid to installation. So here in the debit column, it comes the expenses account with 500 rupees in the debit column, and in the credit account will had cash account, and in the credit amount will had 500 rupees in it. The next transaction is goods given as charity 200. So here it is related to charity, so it will be expenses account transaction. So here we debit the charity expenses account to record the value of the good given as a charity, and we'll credit the inventory account to reflect the decrease in the inventory due to the goods being donated. So goods will be given to them. So in the debit column 200 2000 rupees will be added, and in the credit amount 2000 rupees will be credited. And in the next transaction, John interest change on capital at 7% per annum when total capital were 70,000. Here it is an expenses transaction. So here when it comes to the debit column, here the expenses account is accrued due to the interest of capital. So we'll record the expenses amount and we'll calculate 70,000 into 7%. That will be 4,900. So we'll credit the capital amount that reflects the increase in the capital due to the interest earned. So in the debit account column, interest expenses, in the credit account, capital expense account will be a capital account, and in the debit amount you will have to enter 4,900, that is the expenses of 7% in 70,000, and in the credit amount you will have 4,900, which is capital increased in capital, so you'll have 4,900, so it will be balanced. The next transaction is received 1,200 of bad debts written off last year. Here it is related to the bad debts written off. So here in the debit column, the cash amount to record to increase the cash due to receive the bad debts. You are going to receive the bad debts here, and you'll deduct the amount of bad debts written off. So you'll have to enter in the debit account, cash account is equals to, in debit column 1,200, bad debts written off account is equal to, in the credit column 1,200, so it will be balanced. The next transaction is goods destroyed by fire. Here you lose the destruction of goods by the fire, so you'll debit the loss by fire account, and you'll decrease the inventory value, so we credit the inventory account that reflects the decrease in the inventory value. So in the account, loss by fire account is equals to, in the debit column 2000, and inventory account is equal to, in the credit column 2000. The next transaction is rent outstanding. Here it is an expenses. So here you will record the expenses incurred from the outstanding rent. So you'll debit the rent expenses account in the debit amount 1000 rupees, and you'll credit the account payable account to reflect the liability of the unpaid rent. So you will credit 1000 rupees in the credit column. The next transaction is interest on drawings. So here it is like income related transaction. Here you'll do a payment and compensation. So your cash account will be recorded to sorry, it is interest account. Yeah. Here interest on drawings. It is related to the capital one. Here we debit the drawings account which records the amount of 900 rupees, which represent the income on the drawings. It is a part of capital account. So you'll debit the drawings account in the debit column and with the 900 rupees, and we credit the interest expenses account which reflects the expenses occurred due to the interest of drawing. So this is, and you'll credit 900 in the credit column. The next transaction is Sudhir Kumar, who owed me 3000, has failed to pay the amount. He paid me a compensation of 45 paisa in a rupees. So here we it is related to uh, two types of debit account and one type of credit account. Here it's Sudhir's Kumar payment and compensation description. So when we debit the cash amount from the account Sudhir Kumar paid with 45 paisa, we also debit the compensation expenses account for the compensation received also, which is 90% of original amount. That will be like in 3000, 90% of amount will be 255 paisa. We'll calculate the paisa here. So we finally credit the amount received account to reflect the decrease in the amount owned by the Sudhir Kumar. Here the transaction will be debit cash account 45 paisa and debit compensation expenses, that is 255 paisa. So when we had this both paisa, we'll receive 3000 rupees. So we'll credit the account receivable in the credit column with 3000 rupees paisa. Here you have to understand the compensation expenses 90% is 255 paisa. That will be uh, included in the 3000 rupees, and the remaining 10% is 45 paisa. You have to consider it as a cash. The next one is the last one, commission received in advance. So your commission will be received in advance, that is through cash, nothing is given. So through cash 7000, and unearned revenue is commission through 7000. We debit the cash account to record the amount received as a commission in advance with the rupees 7000, and will credit the unpaid revenue, which is unpaid revenue, which reflects in the liability for providing the services or earning the commission in the future. So that will be 7000. This is how you enter and prepare the journal entries with the transaction. Let's understand the ledger account. Here, the ledger account is a fundamental component of double entry system used to record and summarize the financial transaction. It is a detailed record that provides complete history of specific type of financial transaction for an individual assets, liabilities, and also revenue and expenses. Here, the ledger accounts are organized in the journal ledgers. and which is a comprehensive record of all the transaction or accounts used by the business. So your ledger account is nothing but a detailed record of tracking the transaction and balancing a specific account, such as cash account, um, account receivable, inventories, and all other. Here, each ledger account consider the information about the date, description, and amount of each transaction, which results a result will be balanced. So these accounts helps the business to track the each financial transaction, monitorize the financial position, and also prepare the financial statement. This helps us to understand each specific account like cash account, account receivable, inventory, etc. Here are some key points about ledger account. The first one is individual account. Here we are going to prepare an individual account like equity account, account payable, revenue account, expenses, cash account, liability account, like this. So this each ledger account represents a specific element of company financial position or a performance. The next one is double entry system. Here we are going to follow the double entry accounting system. So every transaction affects at least two account. So one account will be debited and one another account will be credited. So we are going to ensure the accounting equation by preparing the double entry with the accounting equation, that is asset is equals to liability plus equity, and every time it remains balanced. The next one is debit and credit. Here we'll use this debit and credit to record increase and decrease in the account balance. So it might balance in both debit and credit. The rule of the debit and credit depends on the type of account. For example, let's have asset increased with debit and decreased with credit. When liability and equity increases, the credit with credit and the decreases with the debit. Did you understand? Here, the asset increases with the debit and decreases with the credit. One will be increased and one will be decreased. When it comes to the liability and the equity, here when asset is increased, here liability and equity also increases in the credit and decreases in the debit column, opposite direction. So it will be balanced. The next one is balance. Balance of ledger account is determined by calculating the difference between the total debit and credit. So to follow this, we have to follow the accounting equation, that is asset is equals to liability plus equity. If the debit exceeds the credit, the account has a debit balance, and the credit exceeds the debit, the account has a credit balance. This is how it works. The next one is reference to journal entries. Ledger account are closely tied to the journal entries. So here, without understanding or without journal entries, you cannot prepare the ledger accounts. You can't. Without seeing all this transaction and without having journal entry, you cannot post the ledger entry here. So you have to have the journal entries. Each transaction recorded in the journal entry corresponded to an enter in one or more ledger accounts. As I told, it will be in the debit column and credit column also. The ledger account provides a detailed breakdown of the transaction associated with a particular account. The next one is posting. Here, posting is the process of transferring the information from the journal to the ledger account. From the journal entry is made, the amount are posted to the respective ledger account to keep a detailed record of each transaction. We have to post the entries which are given in the journal will be posted in the ledger account with the amount. The next one is organization. Here, in a manual accounting system, ledger account are often organized in alphabetical order or by account type, that is assets, liability, and equity. In a computerized accounting system, they are typically organized in structure chart of account. Let's post this transaction into a ledger account. So we have to understand it carefully. We'll go one by one. Here, the first one is cash paid for installation of machine, 6,000. So the transaction was expenses account 6,000 was debited and the cash account, that is 6,000, credited. So here will be two types of account. One is cash account and the expenses account. In the cash account, you will go and debit the expenses account. Will add the expenses account in the debit column with 6,000 rupees. And in expenses account, you are going to credit the cash account, that is 6,000 rupees, in the credit column. This is how you post the ledger. So you have to understand the two types of account. By seeing the ledger account, you have to post it in the journal entry. The second one is goods given as a charity, that is 2,000 rupees. Here you'll have two accounts, that is expenses account and inventory account. So here in the expenses account, as I told, in the first transaction you'll have an expenses account where the cash will be credited with 6,000 rupees. Like that only, you have to, in that account you have to add the in the credit column you have to add cash account or inventory account, that is 2,000 rupees. And in the inventory column or cash column, you have to debit the expenses, that is 2,000 rupees, you have to debit it. And in the interest change on capital, 7% per annum when total capital was 60,000. Here you'll have two accounts, that is interest expenses and capital. In capital account, you are going to debit the amount, that is 4,900. That is in 60,000 you'll have 70%. You'll get an amount will be debited in the uh, which account? Capital account. And you, in the capital account, you are going to debit the expenses. In expenses account, you are going to credit the capital. The next one is receive 1,200 of bad debts written off last year. Here you'll have two accounts, that is cash account, and cash will be debited here and the bad debts written off will be credited here. So when you go and enter in the bad debts account, you'll add debit account, cash account, and you'll go credit in the bad debts in the cash account. This is how you enter it. And in the next one is goods received by fire, that is 2,600. Here we'll have two account. One is loss by fire will be related to the destruction of goods by fire, that is loss related. So you'll debit in the goods account. And when it comes to the inventory, that is credit, you'll credit it in loss by goods account, 2,000 rupees as a credited. And the next one is rent outstanding. Here you'll have two accounts, that is rent expenses account and account payable account. Here in the expenses account, you'll go and credit the account payable 8,000, account payable 8,000 rupees, and you'll go and debit the uh, rent expenses in the account payable account with 8,000 rupees. And the next one is interest on drawings. Here there'll be two accounts, that is drawing accounts and interest expenses. In expenses account, you'll have debit drawings account, that is 900 rupees, and in the drawings account you'll go and credit it the expenses account 900 rupees. 5,900, it is 900, actually it is they typed a mistake. And the next one is Rakshita, who owed me 3,000, has failed to pay the amount. She paid me a compensation 45 paisa and rupees. So here you'll have three types of account, that is cash account, compensation expenses account, and account receivable. Here two will be debited and one will be credited. Here in the cash account, you are going to debit the account receive credit the account receivable and debit the expenses compensation account. And in credit, when it is account receivable, you're going to debit the cash account and the compensation expenses account. By seeing the journal entries, you can post the ledger account easily. And the next one is commission received in advance. Here we'll have two account, that is cash account and unearned revenue account or commission account. Here in the cash account, you're going to credit the commission account 7,000 rupees, and in the commission account or revenue account, you're going to debit the cash 7,000 rupees. Your salary paid. Here this is one new account, nothing but your you're going to pay the cash. Here will be a cash account and a salary account. Here in the cash account, you're going to add a salary account with 6,000 rupees, and in the salary account, you're going to add a cash account with 6,000 rupees. This is how you post the ledger through by analyzing and understanding the journal entry.